Jake, and he's going to get us started.
Thanks, Greg. I'd like to thank everyone for taking the time to be on the call today. I know your time is valuable, so I appreciate you taking this time. I wanted to remind everybody that I will handle questions for the webinar if you have any, but because of the amount of people on the call, instead of opening your lines, we prefer to allow you to type them into your chat bar. There should be a chat bar somewhere on your screen as part of the webinar. You can feel free as a question comes up to type it in there, and then when we get to the end of the webinar, Dwayne will actually read those out to me and I will respond to them. So today we're going to discuss some of the key product features and benefits that hopefully will help you transition from the spreadsheet to selling value. My goal is to help you become a trusted advisor so that you can beat your competition every time and provide valuable features that hopefully will benefit both you and your clients down the road. So let's get into it. I'm going to start with term insurance products. Term insurance is almost sold as a commodity today. It seems like there's very little thought put into a lot of time what are the potential differences between different term insurance contracts. It's just what is the best price a lot of times is what it comes down to. But there's so many other features you really ought to be looking into to do the best you can for your client. First of all, of course, you want a strong carrier. That goes really for any sale. Some of the things I look at for term insurance are pretty basic, but could be easily overlooked. You want a good conversion period. How long do they let you convert? Now, a lot of carriers are pretty generous on this. Something typical would be you can convert for the level term period or to age 70, whichever is less. That's fairly typical, but some companies are not so generous. We have some that only let you convert for 10 years regardless of what your term length was or what your age was. So you can see that that could be a big deal. Also, more and more it's becoming important what products they allow you to convert to. We've seen more and more carriers as GUL products have become harder for them to sustain. What they've done, especially since everybody's racing to get the lowest term price they can, what they're doing kind of behind the scenes, a lot of companies are saying, you know what, you can convert for 20 years or 30 years. However, we're only going to let you convert to our best product, the products we offer to new clients, only for the first 5 years. Okay, and most of your clients aren't going to convert during the first 5 years probably. So they're going to end up in a situation where they have this, quote-unquote special conversion-only product, which translates into more expensive and not as many features. So it's important, in my opinion, to go with a company that allows you to convert to anything they offer to a new client. That's really the best situation you can be in. Finally, there's some bonus features that certain term contracts have, kind of some extras, some kickers, so to speak. And we'll talk a little bit about that. But what I thought we'd do to kind of explain some of this is I'd look at some term spreadsheets. You're all familiar with what we're looking at here. This is what I would send you when you ask for a term quote. I wouldn't normally include quite so many carriers, but for illustrative purposes, I've done it here. So when you get this quote, what a lot of agents are going to do is they're going to look at this and say, Savings Bank is the best price. I don't know if my client's going to recognize Savings Bank. I'm not contracted with them. Oh, look, American General is only $4 more. I like American General. Let's go with that. Okay, so that would be pretty much as far as it goes a lot of times. We like American General as well, but if I was selling to my client here, I would keep going because I know that American General, while they have good permanent products, they only allow your client to convert to their best product for the first 5 years of their term contract. Okay, so I would keep going. North American, that would be a good option. However, this client's got a few health things going on. North American's pretty tough. I'm kind of afraid they might give that client standard, so I'm going to keep going. Transamerica's got the same issues as American General. And then Banner, well, their term products are good, but they don't really have great permanent products, so the conversion doesn't look good. So I've highlighted the first one where I would start, Lincoln. So that's how I would go through this. Lincoln allows you to convert for the entire level term period up to age 70. So in this case, this person's 45, their term period goes to 75, they're going to allow them to convert to age 70. Okay, so that's a pretty good option, and they allow you to convert to everything that they offer to new business clients. So that's good. And look at the difference in premium. It's only $30 more a year than SBLI. There's really no reason why, in this case, you shouldn't just be skipping past the first ones and selling Lincoln. And I might even go one step further with this and go down to United of Omaha. Why? Because United of Omaha allows you to convert all the way to age 75. So 5 more years of conversion in a period of time where your client statistically is more likely to start having some health issues. So you can give your client 5 years more conversion. They also allow you to convert to any of their permanent products. So you end up selling something to your client that gives them a much better value. It only costs them $172 a year over the absolute cheapest product. And you've put yourself in a position where you will have more opportunity to have a conversion down the road and to help your client out long term. So that's number one I wanted to bring up. I wanted to look at another spreadsheet here to bring out a couple different points. Okay, so this one, male age 50, 500,000, 20-year term. Okay, so Transamerica's got some conversion issues. SBLI also has conversion issues, but the other problem is your client's probably not heard of them. And then we get to Protective. Okay, so I'm going to highlight Protective here because Protective has an interesting feature, kind of a bonus feature for some clients, it will be, and it makes them unique. Most companies, what happens when you get to the end of your term period? Well, you go into an ART mode, so if you don't convert the thing, your premium starts going through the roof quickly. Okay, Protective doesn't do that. They do it the opposite of that, and it actually looks pretty attractive for some people. Instead of increasing your premium at the end of the term period, they let you keep the same premium, and then they start reducing your death benefit from year to year. So you would still be able to pay that premium. Maybe your client can't afford a huge jump in their premium, but they're just going to take somewhat less death benefit every year. So that can be very attractive for some clients. So I would look at Protective in this case potentially, and then I go all the way down to United of Omaha, because even though this is a 20-year term, they'll allow this client to convert to 75. They don't limit your term conversion to your level term period. So those two products, and you can see, again, the difference. These companies are all competitive, right? So the difference in premium is very low. I want to show you kind of in a picture here what Protective's product looks like. If you ran an illustration on that Protective term contract, you can see we've got a 20-year term here. We got a level premium, $500,000 right here. The term period ends. So you can see your premium continues to be the same, but your death benefit drops. It does drop pretty quickly, but this client, say they couldn't afford for this premium to jump to whatever it would be. It could be a huge jump. It could be $10,000, $15,000 easy, okay, or more. And so in this case, they keep the same premium guaranteed, and they still got $170,000 and $150,000, $120,000. So you can see this gives them several years where they've still got a decent death benefit, and they didn't have to pay any more, even though they're pretty old at this point and they're outside of their level period. So keep that in mind. That's a valuable benefit, I think, that Protective offers to your clients. One more term spreadsheet scenario before we get into permanent products. I wanted to bring out one more point that I think is pretty important with our carriers. We have a 75-year-old female, $250,000, 10-year term. Now, we've used this to generate sales before, and these end up being some pretty big sales. This client's 75. Most companies are not going to give any conversion to this client. Okay, so I'm going to skip down through all these companies, but look, Prudential, it actually has a clause where they allow you, your client, to convert for the first 5 years of their term policy, regardless of the age that they got their term policy. So they'll write the term up to age 80, and they'll give you 5 years of conversion. So in this case, with a 75-year-old, they can convert all the way to age 80. Okay, so you can get the client into the product for a pretty low premium, and then you can say, hey, we'll look at this, and we can revisit getting you a permanent product next year or the next couple of years. And that's actually worked out for some of our agents before. So this is something to keep in mind for your older clients who are still trying to get term insurance. And as you can see, about $600 difference in premium. It's a little bit bigger difference than the other ones because this client's older, but still that's definitely worth, in my opinion, the 5 years of conversion versus no conversion. All right, I wanted to look at, these are the bonus features, kind of some other features that I mentioned at the beginning of the webinar. Some of our term insurance companies have living benefit riders. I'm sure you all have been hearing about chronic and critical illness, long-term care that we can offer on permanent contracts. That's very popular. Most of our carriers are doing that in some form or another. However, it's still pretty unusual for term insurance. However, you can offer this on term. Transamerica allows it. They have a product called Living Benefits Term. That's probably the best or one of the best products for that on the market. American National offers it automatically with their term insurance contracts, and so does Assurity. So we've got 3 carriers on the term insurance side that are willing to offer living benefits inside their term contracts to your clients. So that's a pretty big deal. And this is probably something that you really could pretty easily sell to your younger clients because, for instance, Transamerica's living benefits product, it's not going to cost much more for somebody that's younger, very little. Okay, so that would be a good value add you could put on there. Term laddering. Okay, you may or may not be aware that some of our companies allow you to ladder term contracts. Sometimes you run into situations where a client might need a certain amount of coverage for 30 years and a certain amount for 20 years. It probably won't be exactly those figures, but it'll be something close to that. You know, they've got some sort of decreasing obligation like a mortgage. And instead of writing them several different contracts, Banner and Transamerica will actually allow you to ladder inside of one policy, meaning that they'll write a 30-year policy for, say, $1 million with a 20-year rider for $500,000 and a 15-year rider for $250,000. There's a lot of flexibility there. And what that does is they combine your face amounts, so you get whatever the best term band you could get. You get that, and also you have one policy fee. So it makes that whole process more affordable for your client. It also puts everything in one place for them. That's something to keep in mind. American General here has an interesting feature. You may have noticed they have odd lengths of term. So most companies are going to say 10, 15, 20, and 30, right? But American General will actually allow you to ride a 17-year term or an 18-year term. There's a lot of different options in there. Where we see this having some traction is in cases where your client comes to you with an old term policy, wants to know, you want to see maybe if you can do something better for them. Well, what if they have, like, you know, something weird left on it, like 17 years? I mean, this is going to happen a lot. You would have to write them either a 20 or a 15, and it's not exactly comparable, and the price is going to reflect that. However, with American General, you could just say, well, why don't we replace it with a 17-year term? The price is better than what you've got. This company is a little higher rated than what you currently have. So it allows you to match that and gives you some opportunities. Also, you know, you may have clients that are very particular. You run into somebody who says, well, I have this obligation for the next X number of years. Why am I paying for this 20-year term that's farther than I need? Well, you can match it exactly with American General. Greg mentioned this, Principal's Accelerated Underwriting Program. I wanted to bring that up because they actually allow you to get up to $1 million up to age 60 on a non-med basis. So that is a big benefit with Principal. Their term rates are kind of middle of the road, but you know, for anybody up to age 50 or so, you're looking at probably a very small difference between, you know, whoever's the best and whoever's in the middle of the pack anyway. So they can get the process done quickly for you, then get rid of that non-med. It's a pretty simple process. If you're interested in it, give me a call and I'll go through all the specific details with you. But that's available on their term and also all their permanent products. I wanted to briefly mention John Hancock's Vitality Program. You've probably heard of it. We've done some promotion of it, or at least we've talked about it so that you'd be aware of what's going on. Basically, John Hancock has partnered with Vitality, and they now are offering this program where if your client is following certain health patterns, in other words, they're working out, they go to their doctor every year, things like that, they can actually get discounts on their life insurance. They have it on their term insurance contract now. They have it on their current assumption product, which is very competitive, and also their indexed UL, which is a good index product. There's also other benefits associated with this. And I think some people are probably buying John Hancock just to get these benefits, whether or not we agree with that or not. There's cruise benefits, there's discounts your clients can get on different products. So it's an interesting thing. I bring it up mostly because John Hancock is heavily advertising this on the news, or on TV rather. So your clients are going to hear about it, and I just want you to know what it's about. So again, contact me if you've got specific questions on that. I've got a lot of marketing material on it. All right, I wanted to move into universal life products. Guaranteed universal life. I'm going to talk about guaranteed universal life and then what you need to know, and I'm going to talk about indexed UL and what you need to know because it's very different. So with guaranteed universal life, obviously, as with anything, you want a strong carrier. Nowadays, LTC, chronic, and critical illness riders are either free, there's the free type, or there's the extra charge type, but almost everybody has them now, so you need to be aware of those benefits. A big thing that's often missed is, does this guaranteed UL have any cash value accumulation, or is the client locked into it forever? Just like a term insurance contract, you drop it, you got nothing. Okay, so we'll talk about that. And another thing, we have universal life guaranteed UL with return of premium features. Okay, so we'll talk about that. I wanted to show you a spreadsheet. This is what I would normally send you, is something like this, but I drew a red line down the middle. Normally what I send you is right here on the left, and this is what you look at to make the sale. But what I would suggest is that we also keep in mind these other things I've added to the right-hand side of the spreadsheet, these kickers that I've added on here. For instance, if you looked at just this part of the spreadsheet, which is what I would normally send, you'd say, well, Nationwide's a good company. They've got good ratings. Their premium's the best, so I'm going to go with them. Well, fine. I mean, that'd be a good place for your client. However, if you looked at these other details, you'd say, well, look, United of Omaha is only 3% more. They have a free chronic illness rider included where Nationwide does not. And they have a 100% guaranteed return of premium in year 20. So if your client wants to get out of this thing, they can get all their money back in year 20 and just say goodbye, and they haven't lost anything. Okay? That only costs them 3% more. So I think that's kind of a no-brainer right there. Other things I would look at are, we now have indexed universal life products that also have a no-lapse guarantee on them. Okay, North American has one of the better ones, price-wise. So you can see a little less than 10% more. They can have the same guaranteed death benefit, but they can also have the potential to be building up some real cash through the years. You can say, well, look, it looks like that's about the same as that guaranteed return of premium, so why would you go to this? Well, the answer to that is this is a lot more flexible. This is going to have cash in every year, whereas this return of premium and all the return of premium features we have are limited to like 1 year for a 60-day window. So United of Omaha is going to give your client a 60-day window in year 20 and year 25 to get 100% of their premium back. North American, it's more standard. You could take a loan, you could surrender it at any time for whatever the cash is. Okay, so keep that in mind. Just as an aside, Protective also has a good guaranteed index UL. Usually has a good bit more cash in North American, but as you can see, it's also more expensive. The other differentiating feature are free chronic illness riders versus LTC riders versus the kind of chronic illness rider you pay for up front. Okay, a lot of companies have these free chronic illness riders, and I would tend to go with one of the ones with a free chronic illness rider. If your client doesn't want to pay more, at least put them in one that has one of the free ones. Okay, the LTC and chronic illness that you pay extra for is much more robust, and it's good to talk to your client about that as well. My general rule of thumb is on a guaranteed UL, for a male, you're looking at about a 10 to 15% increase in price to add an LTC rider. For a female, it's going to be about 5% more, so 15 to 20% increase in price. Pretty modest increase for most people for the benefits that these LTC riders add. Dollar for dollar reduction of face amount to use for long-term care needs. So very strong benefit. Okay, so that's my basic thought process when I look at selling a guaranteed UL contract. Let's look at indexed UL. Okay, indexed UL products are becoming more and more popular both with agents and with clients. I think that part of the reason for that is that our companies are actively marketing them, and they're coming up with more and more features that are very beneficial to your clients. So what do you need to know about index UL contracts? It becomes pretty complicated, pretty complex, and hard to compare them. But we're here to help with that. Obviously, the cap rate, the floor, the participation rate, that's pretty basic. That's important. What index account options are available to my client? Is it just an S&P 500 point-to-point? Do they have monthly accounts, other domestic accounts? Do they add global possibilities in there? Those are all things to keep in mind. Loan provisions are very important to me, especially when you're looking at doing this for a LIRP, life insurance retirement plan, when you know your client's going to take money out. Some companies have guaranteed wash loans, other ones do not. Some companies have a variable loan rate that they'll guarantee you won't go over a certain threshold. Some companies don't cap it. So there's a lot of differences there. Persistency bonuses is a big thing. You may not even notice this, and that's something I want you to notice. Some companies, most companies actually, have what they call a persistency bonus of some sort. What that means is that after year 10 or after year 15, whatever it is for that carrier, they're going to add a certain percentage to what your client is earning. So they're going to say, we'll add 50 basis points, or we'll add a full percent in those years to kind of reward the clients that keep the policy longer, and of course it makes the illustration look better. The problem with this is that some carriers guarantee it, and which is great. I love that. Other carriers don't guarantee this persistency bonus. I think that's a little bit tricky, so you need to keep that in mind. And then, of course, premium loads and expense charges are important for these type of contracts where you're trying to build cash. I always print out an expense report, and it's easy to get on these IUL contracts, so you can kind of take a look at what the actual expenses are before your client starts earning anything. And it's actually very useful for comparing companies, which one has the better cost structure. And then there's, lastly, some bonus features on many IUL contracts, chronic, critical, and then there's sometimes it's very important to have a surrender charge waiver on these contracts, and some of them have it. I wanted to put two illustrations up here to kind of show my thought process side by side. We've got two illustrations. There's the one here on the top and the one here on the bottom. I structured them exactly the same. This is a typical LIRP type sale. We've got $1,000 a month going in to age 65, and then at age, we're going to let it grow a little bit, and we're going to start taking income for 20 years starting at age 70. So what do they look like? We've minimized the death benefit, minimum non-MEC. These things are about as good as they're going to look. I've run them both at 6% just to keep the numbers easy. All right. So this is kind of blurry here, but you can see one carrier lets you take out $25,000 a year. The other carrier lets you loan out $26,400. Okay. Not a huge difference considering all the different factors, but how would you choose besides just that difference there between the two companies? All right. Well, company number one up here has no guaranteed wash loan, okay? So you cannot guarantee your client that they can have a zero-cost loan at some point in their policy. That's kind of a big deal to me because I want to have as little of a risk profile in retirement as possible. This company guarantees you a wash loan, okay? So we've got one check for this carrier down here. They guarantee your client that they'll get a wash loan if they choose a fixed loan option. Okay, this company up here has a 2% minimum interest rate. That doesn't mean that their floor is not zero. You could get zero in any 1 year, but they guarantee over time, usually somewhere about 8 to 10 years rolling, that you will get 2% compounded, worst case scenario. That's a nice bonus feature. Not every carrier's got that. However, this one does too, and it's 3%. So another check mark for this company. Looks a little bit better. Okay. Here's a big one. This company has a persistency credit, but they don't guarantee it. So it's almost like smoke and mirrors. I mean, they're saying they're going to give you this added bonus, but they're not willing to guarantee that they give it to you. So it's almost like they're just making their illustration look better in later years just to be competitive. Okay, I'm not saying they're trying to be tricky, but it kind of comes off that way to a client. This company, however, gives you a persistency credit, and they guarantee it. Great. That's a huge bonus to your client. Last point here. This company has an extra charge LTC rider. That's a good thing. Not going to knock them for that, but not everybody getting an index UL is going to want to pay extra for long-term care. I don't really blame them because I would put it on a guaranteed UL rather than a cash value product. I have a lot of reasons for that. but it's not a free rider here, and they don't have any critical illness. This company has a free chronic illness and a free critical illness rider. Okay, so you can see there's some features that really make one product better than another. Even though you paid the same premium into them, you got very similar income, there's a lot of reasons to go with company B there. All right, so that's kind of my thought process in comparing these products. I wanted to bring up one really important thing about IUL contracts is how do you come up with a reasonable interest rate to compare products to one another. This is kind of difficult to do. This tool I'm looking at here is available to you, and it is published by John Hancock. They've gone to a lot of effort to make a good tool here for you to use. It's iultranslate.com, if you want to write that down, iultranslate.com. There's no password required. You can go in there and check this thing out. Down in the marketing library, they give you tons of in-depth information as to how this thing works and what they have done as far as their research. Over here, they have a client presentation, so you can show your client what you've done. This part, I would not normally show a client, but I have used it in situations where the client's already been shown an IUL and they come to this other agent and say, hey, can you do something better than this? And then you have to get in a situation where you're like, well, I can't show you the same interest rate. I really need to show you something different because this product has a much higher cap, okay? And that kind of justifies your thought process there to the client. So what this does, you put in the participation rate, your floor, and your cap, and based on what you think is a good long-term equity return, say in the S&P 500, whatever equity you're using for the index, they calculate a translated rate that takes into account this information down here and gives you what they think is reasonable. In this case, if you think 9% is reasonable in a long-term equity with a 13.5% cap on your index and 100% participation, they think 6.8% is what is going to be reasonable. The issue is what do most companies show as their maximum illustrated rate, or at least used to show. They would show this, look-back rate, 25, 30 years. So they're letting you quote 8.28%, but John Hancock is calculating here that in reality, they don't think anything more than 6.8% is very reasonable, okay? The Milner Group has always been very conservative in our approach to illustrating these products, so we've always been in that range or lower, around 6% or so, what we've shown. Interestingly, the NAIC agrees, and the new regulations that have come out are limiting carriers to what they can show. You've probably seen that with some companies, but maximum illustrated rates are coming down to somewhere around 7% or a little bit more, up to 7.25 or so. Also, they are about to come out with another regulation that is going to say you can't show a interest rate arbitrage on a loan greater than 1%. I think that these are good for clients. I think products may be modified sometimes in such a way where this won't be helpful to the client, but I think this is going to help put us all on a level playing field when we illustrate these products, that we're not showing wacky numbers. Okay, this tool is available to you. If you're not comfortable using it, or you just want us to help you with it, feel free to call me up and I will run this for you, send you a report. So why do we go over all these features? Well, I want you to become a trusted advisor for your client, and I want you to beat your competition, and I want you to do the right thing for your client long term. So who are some of the most universally trusted advisors that you know? Doctors, right? So when you go to the doctor, he's going to run tests, and if necessary, he'll write you a prescription to help treat your condition. However, when you get your prescription, there's not going to be a list of medications to choose from, right? No, your doctor is going to recommend what he thinks is the best one for your particular condition, because he knows that the average consumer is not really educated enough to make that decision, right? I think that the same principle applies to selling life insurance with a spreadsheet. You put a big spreadsheet in front of your client, they're not really going to know why they would pick one company over another, except for which company markets better, which one have they seen on the Super Bowl, or wherever it is. However, if you do your research as an insurance professional, you can become the trusted advisor who's equipped to recommend the absolute best products to your client. However, I do not expect you to remember all these subtle nuances we've gone over today. That's what we're here for. The Milner Group stays on top of all these things for you, and we're here to help. So please give us a call, and we'll be glad to assist you with any of your cases. All right, well, that pretty much wraps it up for today. If you've already typed in questions, that's great. If you've got any more questions, feel free at this time to type them into the chat box on your screen. Dwayne, do we have any questions this time?
Yeah, we do have a few. Let's see, first one here. What carrier other than Met provide external term conversions?
External term conversions, we've got a few carriers that still do that. Symetra offers that. Transamerica has a program for that. National Life has a program for that. So there's a few options available, but they're all different in exactly how they work. In other words, how long a time period they'll allow you to convert from another carrier, which carriers they allow you to convert from, although most of them are generous in that area. So if you have a particular case where an external conversion makes a lot of sense, give me a call and we'll look at what's available and try to find the best one. Generally, though, Nationwide has one too. Forgot about them. Generally, though, what I was saying is you only have about 5 years to make one of those work. After that point, most companies aren't willing to do it.
See, how about current policy versus contractual?
Oh, okay, I get what you're saying. I think the question is saying what products can you convert to? Is it what they currently offer and that could change, or do they contractually guarantee what you can convert to in the future? I'm guessing that's what that question was. So most companies, unfortunately, if you read their policy, what it's going to say is, if it's a good company, they're going to say something like, you can convert to anything we currently offer our clients. However, this could be changed by the company. So most companies give themselves the ability, the loophole, to kind of get in there and make a special conversion-only product. The only one off the top of my head that allows you guaranteed to convert to whatever they have offered to their new clients at that time is John Hancock. So that's a really good feature of John Hancock. However, right now, John Hancock's conversion features are not great unless you buy an additional rider with them called the conversion extension rider, which increases the cost of the policy, but it gives you that conversion for the level term period or to age 70. So if you're specifically concerned about that verbiage, guaranteed to be convertible to anything, then John Hancock's the way to go.
See, how about convertible waiver of premium?
Convertible waiver of premium is a good feature, and not a whole lot of carriers offer that. MetLife has a specific rider. They actually differentiate. This is unusual. They differentiate between a regular waiver of premium and their special convertible waiver of premium contract, where you can actually convert the contract with waiver of premium on it to a permanent contract and have your whole life contract premiums waived forever. So as you can imagine, that's kind of an expensive rider the way MetLife does it, but it's really kind of a Cadillac rider. It's definitely beneficial to your client. It's just kind of expensive. We do have a few other carriers that allow you to convert waiver of premium. Prudential does, for instance, but there's not a whole lot of carriers that do that.
Let's see. This one looks like he's looking what was the age, sex, and underwriting class for the GUL illustration and the GUL coverage amount.
I don't remember. I think, let's see here, actually, I can tell you. It was, a female age 40, $1 million guaranteed for life.
And what was the underwriting class on it?
Preferred, regular preferred.
Okay. And let's see, this one right here on the side-by-side illustration, the notation on the top of the illustration is not what we see. So
on the side-by-side, I'm not sure which.
I think that was the one where you had the illustration going from the top and the bottom between the carriers for the IUL contract.
Oh.
Did you add those on there yourself?
Oh yeah, that's not a report that any software is going to generate. I just ran 2 separate illustrations with companies that are similar to each other, and then I, used some software to take a picture basically of what I wanted to show, and then I put them together in a composite and put it up there for you. So, yeah, that's not something that's going to be coming up all the time because that's pretty labor intensive, and no software does it for us.
Let's see. Do you have a cheat sheet on who should apply for Principal Quick Issue Program?
I should have mentioned, I left out one of the key features. Yes, I do have the checklist. I can send that to you. Just shoot me an email and I'll get that to you, the checklist of who should apply. But the program applies to people who you think are either preferred best or preferred risk classes. So if you think this person is most likely a standard or worse, then you need to go through full underwriting, because for Principal is going to knock them out of this program if they have any conditions that show up on the MIB, prescription check, MVR, anything like that that's going to indicate worse than preferred. They're just going to throw them out and put them in regular underwriting. They don't reject them. They're just going to say, you know what, we need to go through the full underwriting process, and that's just a waste of your time and your client's time after you've told them they're going through accelerated underwriting. So really only discuss this with somebody you think, yeah, this guy's preferred best, easy preferred, that would be the client you'd use.
Okay, and I believe that's all we have for the moment.
Great. Thank you, everybody, for being on the call. I appreciate your time. Send me an email, give me a phone call if you've got any questions, and I hope you have a great day. Thanks.